The Fed's poised to cut rates for the first time in 4.5 years. What does this mean for markets? Let's ask George Cipolloni of Penn Mutual Asset Management, and I'm Lisa Bernhard with Reuters. George, before we get to what the size of the rate cut may be, give us some context as to how stocks usually perform after a rate cut.
So outside of what the actual cut may be, if you think about history and what happened to the markets after the Fed cut, it's really recession dependent. So, and we don't know if we're in a recession or not yet, but if the market is not in a recession, if the economy is not in a recession, the market tends to go up roughly 10 to 15%. And if we are in a recession, the market tends to go down about 10 to 15%. So it really is two different different and binary outcomes from a potential standpoint in terms of what the stock market may do in terms of the reaction.
And how soon will we know if the economy is sliding into a recession?
So the trickiest part about knowing when the economy may slide into a recession is that it just takes time. And we aren't going to know this week. We may know over the next few quarters, over the next handful of months. So I would say over the next 3 to 6 months, over the next few quarters, we're going to start to get the readings in. We're going to start to see what employment is doing, what GDP is doing. Most importantly, what inflation is doing. I think the one thing that most people are not discussing enough is the reason why the Fed has had to hold on so long and not cut rates sooner was because inflation was persistently high, and it still is. If you look back at past rate cutting cycles, if you go back to 1995, for example, through 2019, inflation was a lot lower than it is today. So that still will be the fly in the ointment. Does the Fed reaccelerate growth, reaccelerate inflation from here? And again, what impact that will have on their decisions.
What is the bond market telegraphing right now, and what do you expect to see from bonds after a rate cut?
The bond market is telling us a really important story, I think, and the reason why it's so important because it's so drastic. If you look at the 2-year yield relative to the Fed funds rate right now, it's at its widest gap in 35 years. So what is that telling us? The bond market, or at least the 2-year, and certain parts of the yield curve are telling us that the market may already be in that recession territory. Now, again, we can offset that with other economic statistics, but at least in terms of what the bond market is forecasting, the bond market is certainly forecasting weakness. There are huge bets out that the Treasury market will do well in this next Fed rate cutting cycle. And so, again, just looking at that tea leaf, just the bond market, it is telling us that there may be some weakness ahead.
Now, let's get to the size of the possible rate cut that the Fed may announce. Investors are still betting on a more than 50% chance that it will be a 50 basis point rate cut, larger than the market has been expecting when just last week the bets were of a 25 basis point rate cut. What do you expect to see Wednesday and going forward from the Fed?
So in terms of the actual size of the cut, one of the most interesting things that we are seeing, B of A posted a note that this will be the most uncertain FOMC meeting in history going back to, as they've measured it, back to 2015. And that's very telling. And that's also consistent with what we've seen in the Fed funds rate and the jump from 25 to 50 basis points, where now 50 basis points has the highest probability of happening. And that happened very, very quickly and very, very swiftly last week. And so going into it, I would think, unfortunately, that the market has 50 priced in. And I do think, even though the odds are, if you look at historically, the Fed rarely starts with a 50 basis point cut. They've only done it twice in the past few decades. They did it in 2021 and 2007. Both of those periods were recessionary periods. And again, we don't seem, from an economic recording standpoint, that we are there yet. But again, this is what the market is forecasting and guessing. And I do think if we get 25, the market could be disappointed, at least in terms of stocks.